this could be an additional way to sock some money away.
The Senate passed this idea of no tax on tips.
I was surprised it got unanimous support in the Senate.
So, hello everyone. Thanks a lot for joining us. This is Steve Taylor, and you are joining us on the Do It For Yourself podcast. And so today's episode is a little bit of a different format, which we don't get to do very often, but we're trying to do more, is where we come in and we really bring some subject matter experts, and myself included, to discuss things that are really on the forefront right now. Everyone's talking about their issues out there that affect people individually, primarily their businesses as well. And today's topic, I'm excited to talk about because it is really the topic of the day. We've gotten a lot past, what's been happening this year. There's been a lot of noise, a lot of geopolitical, but this is really something that the new administration really hung their hat on as they were coming in, this really big tax bill. And absolutely, because it's a Republican administration, passing a tax bill, really any administration, but the Republicans even more so, I feel sometimes, that's really on the forefront of their mind. So we're going to have a discussion about what's in this bill, what's not in this bill, what's happening. We already had really big news today, and hopefully you find this beneficial. So I have with us really an expert that in many circles needs no introduction. But Brett, give us a little introduction. Tell us about you and your firm.
Thanks, Steve. I appreciate that. Been working with Steve Taylor and Merited Wealth. It's been, I don't know, 10, 15 years now at this point, and he has been just unbelievable for my family, for myself personally, but also clients that we work with together. So I just want to, first just acknowledge and thank him for the relationship for all these years. I work at the firm Palermo, Landsman and Ross. We're in Cooper City, Florida, which is right outside of Fort Lauderdale, Florida, about 20 minutes or so, and we're about 25 people. We're about a small to mid-sized firm, and our specialty is helping, I would say, entrepreneurial clients who have businesses, maybe one company, and we are really specialists in the tax area, but we are full service accounting, so we'll do the normal, the bookkeeping and everyday accounting, to help, business owners out. But we really love the tax side of stuff.
Thanks, Brett. I really appreciate those kind words, and I'll give the same to you. You've really been great with all of our clients. I always love working with you because I think people will see now we like to have these conversations, right? Everything's not necessarily black and white, and we're always looking to see what we can do for our clients. So as we record this, the passing news was that the Senate passed this idea of no tax on tips. And that was a big item that was out there. They were talking about all, the different wage earners out there, that this big issue to help kind of stimulate the economy. And I'll tell you, Brett, my initial thought on this is honestly, it's not a huge deal in the sense that I think a lot of the cash tips that are already out there, I think they're known that they're underreported. Maybe when other people put items out there and they say, that's on the bill, that those do get reported. But this tax on tips, I don't know how big of an issue this is going to be. I think maybe it's mostly just political. But what are your thoughts on the fact that this one passed? This was the first one out of the gates. What are your thoughts on the effect of this?
Yeah, I was surprised it was a separate thing. I mean, I agree with you. I mean, I think that the cash tips are somewhat reported, but not, not in their entirety. I mean, what's in the bill will be essentially a $25,000 deduction on the employee's return to offset cash tips that are, generally supposed to be reported on, in addition to wages. And it's the employees that report the cash tips to their employers, and which go on to their W-2s and what have you. So I don't know, how much those actually make it on an
Yeah.
annual basis, but I think it was I was surprised it got unanimous support in the Senate. It was supposed to be a part of one big bill, and this was kind of separated out. Maybe they had, unanimous support. This was just trying to get some momentum type of thing. But
Yeah.
you have something.
Yeah, and it's interesting, as I was reading into this, they say to qualify as a tip, right, it needs to be something that's voluntarily given by the diner. And so one big question came up, and I think it's a great question, right? That if someone automatically includes a tip on your check, right? If your parties are six or more, does that qualify towards this exclusion? Right? Because that's
Right.
kind
Yeah.
of that's kind of mandatory. So, a lot of those in anything that will come out and we'll see how it changes kind of the behavior. Tips in general. It's always interesting to me how the restaurant industry got away with, hey, listen, we're going to charge you for all these
Yeah.
services, but then the people that are actually out there working on the front line, pay them separately, right? We don't want to
Right.
have to pay them. It's like I imagine if you
Yeah.
walked into your office on the way out, you say, hey,
Yeah.
Steve, thanks for your fee for preparing the return. Can you take care of my preparers and my receptionists on
Yeah.
your way out?
Yeah, I wouldn't if I'm in a if I'm a in a law firm or even the accounting firm, I wouldn't go and start collecting tips for for fees anytime
Right.
soon. It's gonna have to they're gonna have industries that they are gonna associate this rule for on the tax return. I mean, they have a line for what you do. I mean, there'll be some checks and balances and form changes when you file your 1040 every year. So yeah, I wouldn't go ahead and restructure salaries and wages to have more allocated to tips and less to earnings, what have you. So
It'll be
more
interesting.
yeah,
Yeah,
definitely.
yeah, that's good advice there, right? Don't try to, that's always in any when you're doing tax planning, don't try to be too clever, right? To get yourself
Yeah.
into trouble. So, really, one of the biggest items I want to talk about on this new tax bill, which is really just a continuation of what happened during Trump's first administration, is the Section 199A deduction called qualified business income. If you can, Brett, give us a real brief background on it and what's looking to be done in this bill.
Sure. The 199A deduction is so if I have a pass-through entity, which is a partnership or an S corporation, and I'm talking in broad strokes because there's a lot to the formula, but just to for the ease of our conversation, I have a if I have a business, it has a profit of $100,000 in the current tax law. I would report that $100,000 profit on the individual's return, but then I would get a 20% deduction. It's called 199A, and then that would be a $20,000 deduction on your personal tax return. So effectively, instead of paying tax on 100,000 in profit, you're paying tax on $80,000 in profit. And there's other factors like wages come into play and from the business and how much equipment and property you have. So there's a kind of a formula that that's calculated there, but just giving like a kind of a general overview of how it's so the now the new tax bill that I've seen has it going up from 20 to 23%, which is an increase, and that would go forward for several years, that 23% deduction.
Yeah, and how was it? How were, I know specialized service industries, doctors, lawyers, CPAs, financial advisors were treated a little differently. How are they treated currently, and how is this proposing to look at them differently?
Yes, if you're in one of those fields, if you make a certain amount of income, that deduction gets phased out, and if you make over like 350 or so, married filing joint, it's phased out completely. So those professions would kind of miss out on that QBI deduction for the 20%. So now what they're proposing is actually a no phase out for those professions. So it would be a fair game. The deduction for currently was really for all manufacturing, construction contractors, and it's a line on the 1040. So you could go it has to be calculated on the return every year. So that like if you go, I'd go back to your personal tax returns, just make sure you got that deduction if you have an S corporation or you file on your personal as a Schedule C or in a partnership. I've seen those missed before, so something to look at.
Yeah, yeah, that's a very good point. Whenever you're going back and you're reviewing, if you hear something new and you think it might apply to you, check your return. If it's not on your return, ask the preparer. If the preparer didn't know about it, maybe find a new preparer, right? So, one of the other areas of this bill that I'm finding really interesting, it's an area that I have lots of discussion with clients about, I'm very passionate about. It has to do with educational expenses and 529 plans. And really, those people, when they ask about 529 plans and whether they should do one or not, the big benefit of a 529 plan is it allows you to save for education expenses. Now it's being expanded for pre-college. It's not only college. Save for those educational expenses in a manner that that money grows tax-free. So if you're thinking about a 529 plan for your child, the answer is do this sooner than later because it's this tax-free growth that really is the benefit of it. And lots of people have over the years taken advantage of these programs, but then they've ended up with almost too much money in those plans. So they get kind of caught. Like, how do I take that money out? Because if it's not used for qualifying expenses, there's penalties and income taxes to be paid. So the new big beautiful tax act says that now there's additional expenses you can make pre-college, okay, for those that are considered qualifying education expenses. Like you can pay for tutoring for your child at home, standardized testing, okay? If your child has special needs, to pay for those. Now, it's still limited to $10,000 a year, these additional new qualified expenses. And another one aspect of it that not only pre-college but post-college, which I found really interesting, is that let's say if you want to become a CPA, a CFP, an attorney, right? You can use the money from that 529 plan to pay towards that coursework, to pay for that accreditation, right? So that's a really big expansion that really makes these 529 plans more and more useful and really just encourages people to use them and put money into them.
Is that
So
is that different? But that this doesn't count toward like the prepaid accounts, prepaid college, like if you like for the state of Florida or anything like that.
yeah, good question. So a prepaid account is a 529 account, right? 529 is a section of the Internal Revenue Code where you can have savings accounts and prepaid accounts, right? So if you get prepaid pays no, just for college. It can
Mm.
pay for tuition, right? And then it can pay for room and board. These 529s are much, much more expansive, right? So if you're considering and you only have enough money to fund one of them, these 529 savings accounts really are becoming a more and more useful tool.
Mm.
Brett, one of the other big things that I know came out in 2017 and for our somewhat higher income earners, but really in Florida, it's really apropos because, it's the real estate taxes are so high. We'll see what happens with those, right? Whatever's happening with those. But there's a big change proposed in the state and local tax provisions of the code. Can you tell us a little bit about that?
Yes, so you've probably seen the term salt provisions, and it's not a seasoning. It's a state and local tax provision. It's on the itemized deduction schedule, and pre 2017. And you could still do it, but it's just capped at $10,000. Is if you have state and local taxes and real estate taxes, if you pay $100,000 of both combined, you're only able to deduct 10 grand right now. If you live in New York, if you live in California and other high, state tax jurisdictions, that could affect your tax because you were able to before 2017 to deduct, all those taxes. Now you're capped at 10 grand. So it's causing, a lot of issues, for those taxpayers in those states. that live there. So the new, and that's what's kind of holding up this bill, I think, is this provision to raise the cap. So they had it at 30,000. Now they're talking about raising it to 40,000. So essentially, if you have a combination of real estate taxes and state income tax, of 100,000, you'll be able to deduct 40,000 instead of, the 10,000 currently. So I think that's one of the holding factors right now, trying to work through that. But some people want it eliminated completely. Some, and some are, want this cap of some kind.
Yeah, yeah, that's always been a hot topic. Let me ask you, Brett, because I see it a lot on my end, and I always, people will come in and say, "Oh, well, I want to have a home mortgage credit, right? Because the interest is deductible. I want to, this and that, own that house because of all those benefits of it." In your experience, right, and in your clients, you see a bunch of 1040s come by your desk, right? And you don't have to be exact. I'm just curious. What percentage would you guess the 1040s you see for your clients? What percentage of them itemize their deductions versus take the standard deduction?
I think it's since they raised the standard deduction, quite a bit, in 2017, I would say it's probably 60% itemized, 40% standard deduction, something like that.
Oh, you still think it's more item? Okay, because
Yeah, I do.
yeah,
Yeah, there were just refinances and different things that happened over the past, during COVID that I think bumped some people into that, and there's a lot of activity, buying houses, and here with the real estate tax, and the property values going up. So I've seen more of it.
interesting. Yeah, because it's funny. I'm looking at this new provision, and I think of myself personally, right? I always like to do my planning. And now I waited last year. I decided not to pay my real estate taxes until January, right? So I can get 2 years in one
Right.
year in the hopes that the SALT would be increased, right? But
Yeah.
even at that, looking at that, and then looking at my mortgage interest, and then looking at the new standard deduction, I still don't think I'm gonna be able to itemize. I still think I'm gonna fall into standard deduction. So that's interesting
Yeah.
that you see that the gap shrinking, but it's still the majority you see are itemized.
Yeah, I do see that. Yes. Yeah, I
Yeah.
mean, with some people having multiple properties, with yeah, maybe second home or other property, so
Yeah. Interesting. So another really interesting topic, and once again, we're not getting all of them, but Brett and I chose a few that we thought were interesting, was this extension of the qualified opportunity funds. And a lot of people out there, I think, don't know about these. So let me tell you how these work, and let me tell you what a lot of people think about it. So a lot of people think about, when they are selling an asset, they think about real estate, right? And they say, okay, I want to sell my real estate asset, but I don't want to pay tax currently if I don't have to, right? I don't need to take this money. I don't need to use it. I'll leave it as an investment. There's a feature in the Internal Revenue Code which allows you to roll that into another piece of real estate, and you do it in a qualified manner. It's a qualified like kind in real estate exchange, and you defer the tax, and the asset remains out there without paying taxes. And so a lot of people will come to me maybe after they sell the real estate, right? Or after they have some kind of transaction, and they'll say, "Hey, well, I've heard about these things where you can, defer the taxes being paid." And in many situations, I'll tell them it was a piece of real estate. Hey, too late. You needed to take care of this beforehand. You need to go through all these different hoops. But these qualified opportunity funds that came a while back were really interesting because they were one of the few where you could actually execute the transaction and then put money into this fund, and all that gain could be deferred for a number of years. And these really, it really, the incentive and the reason is that these investments were made in underserved communities where investors went in and invested money, so they wanted to incentivize all this investing in those areas. So this was set to expire, I believe it was next year. Yeah, the end of next year. They're gonna extend those for another 5 years, and those are really interesting opportunities that if you've executed a transaction, and now you're saying, oh, I didn't really need this money right now. The tax bill's gonna be a little higher than I wanted. That's one of the few items where I could see that you can kind of do it after the fact and really invest and can and get some tax benefit.
Where do you I mean the qualified, because I know you could set one up on your own. You could set one up on your own. Um or you could invest in one, I guess. Are these like publicly traded like funds or
Yeah, these are large asset man. I haven't seen anybody set them up on their own, but they're the large asset managers that put the ones I've seen put those investments together, right? So the money when it goes into it, it's going to be limited, right? It's not easy to get the money out, and that's the trade-off, when you're saving taxes on it. But that's who I see those made by these large investment companies. Now, one of the other topics that was very political that came up was taxation of Social Security benefits. And it's looking like that's not going to be a part of this bill. That has to go through a whole different process to be able to get that passed. We might see that later in the year. Brett, let me put to you again, right? And you're going in there and you're doing these returns. I know you specialize in entrepreneurs, but I'm sure you have some clients that are on Social Security and they have just maybe investment income. Do you see that? Do you see that? Does that become an issue or a topic of discussion with a lot of your clients? You're seeing that taxation of Social Security. Is that's really something that's kind of a burden that is a good idea to address?
Yeah, I mean, because I think we work with a lot of family-owned businesses, and the owner, the founder of the company, they're they're in their late 60s, early, so they're still they have they still want to continue to work in the business, and before they pass on the company, either through a sale or a gift to the second generation, and they're still getting paid a salary, and they're receiving Social Security benefits, which is throwing them into those benefits into a taxable situation. So I've seen a lot of yeah, I've seen that have an effect, definitely. And then
Yeah.
so it's deciding when to take Social Security, how to structure the salary of someone that's still working actively in the company that gets the benefits. Because once you get to 65, there's only a certain amount of earned income you have to earn. So you have to, before you start pulling the trigger on when to take it, those factors need to be planned out.
Yeah, that's a great point, Brett. A lot of people we're talking about taxation of those benefits, but I think a lot of people get confused when they're deciding whether to take it. And just as you said, they're still working, right? And in the early years, if you're going to start taking Social Security before your normal retirement age, right, which is considered, you have to look out by when you were born, it's roughly around 67 and a half for most people. It's getting later every year. If you decide to take Social Security prior to that age and you're still making a substantial amount of income, you're not going to receive the Social Security benefit. So it doesn't benefit you to turn it on, because what's going to happen is it's just going to accumulate and then it'll pay you later on. But what you missed out on was the potential increase in the monthly benefit, for all the future years that you could have by waiting. So yeah, to your point, that's really, I think a lot of people, they kind of almost default to taking it early, but a lot of thought and planning needs to go into when and how you take Social Security. It could be a substantial difference over the lifetime of a husband and wife.
Because currently it's whatever the benefits you get, they could those could get taxed up to 85%, not the tax rate, but the amount that you
Yeah.
receive. 85% of those are subject to tax. So yeah, we'll see what happens with that one.
Yeah, yeah, really important. And then the final one, which is pretty interesting, Brett, these MAGA accounts, right?
Yeah.
They're allowing these accounts to be set up. It's really interesting. I think a lot of our clients aren't going to, it's not going to affect them very much, but it allows an account. If you open this account before the child's eighth birthday, you can put a certain amount of money there every year, and the money has to be invested in these very low cost diversified portfolios, basically index funds. And then you can get tax deferral, right? For all the way, potentially all the way up to that child becomes almost 30 years old. So they're interesting accounts, right? And what's really interesting about this is I think they're also putting out there potentially this idea that you can open these accounts, and most young kids in the United States, I guess if maybe if you have a Social Security number, that the government will fund this, will start funding this account for you, right, with $1,000. Now, I like that from the idea of, hey, get people thinking about saving and investing very early, so
Yeah.
that they're not, just solely relying on Social Security or whatever else is out there. But it's hard to see whether these accounts are going to be that much of a benefit planning wise versus all the other options we have out there. But the acronym's kind of nice, right, Brett? People that like this administration, let me get my kid in a MAGA account.
Yeah. But do you think, because like you have some clients, I'm not sure, but I have clients that they are not sure, what they don't want to be locked into doing a 529 plan out of the fear of their kid not going to college or whatever, and they're not sure of the future and having so much of the funds going into a 529 account, so they set up a joint account with their kid, UTMA account. And then when the kid's 18, they get that account. Do you think this it will replace, like, would you recommend the MAGA account over this account, or like what's the strategy? What do you think?
So we don't have the details. If you're going to go simple UTMA account, right, where the account becomes available to the child at age 18, it looks like the MAGA account, well, with this limitation, right, the max is 5,000 you can put in a year. It looks like the MAGA account may be a better way to go because of the tax deferred aspect of it, right? So that would be better over the UTMA account. But the challenge of both those accounts, right, are that at age 18, the money becomes the child's.
Yeah.
Right. So
Yeah.
so it's kind of, it's when you're looking to save, for the child, whatever it might be, the conversations I have to your question is this money, is your intended it to be the child's money or is intended to be for the child? If it's the child money, maybe you do an UTMA or this MAGA account, that'd be fine. But if it's for the child, right? If someone else is giving it for the child, you're really going to be better off maybe to create it's a 529 account, or if it's a large enough of money, you do an individual trust, maybe that's out there, to really think about where to put this. And once again, like, great point, right? The limitations of but the 529s are becoming more and more expansive, right? We mentioned earlier that you can also, they're expanding what you can use pre-college and the post-college certification. But
Yeah.
also a couple of years ago, they passed a rule that if up to $35,000 is left in the 529 account, once the person doesn't have to go to school anymore, you can roll that money over into a Roth IRA for them.
Yeah.
So I totally hear you, right? I think we might have done, your concern you might want to do not non 529, but
Yeah.
there all these rules are coming to really say, please, we're not going to make it as limiting. We're going to give you all these benefits that they're really encouraging people to do 529 accounts. And for the majority of people, I think it's going to be the 529 investment account is going to be a good choice.
They put a lot of business owner clients will put their kids to work, and you pay them and stuff, on the through a W-2, but maybe to try, and they also have retirement plans inside their companies. This could be an additional way to sock some money away, not a tax deduction, but to have some savings for their kids as well.
Yeah, lots of options. That's a great point. There's a lot of planning to be doing around all of this. So, Brett, buddy, I thank you for the time. And listen, we're going to have to come back when all this gets passed. I mean, we have the tips. The tips just passed today.
Yeah.
But when we get more detail and clarification, maybe we'll come back and we'll put all your information in the show notes and everything, so people can reach out to you and learn more about you and your firm, and maybe come in and say, hey, listen, this is what's been passed, and maybe here looks like some planning opportunities.
I would love to do it again. It's a lot of fun. So I'm whenever you're ready, I'm here for you and for
And
advice.
yeah, great. Thank you, Brett. And no matter however they say for college, what college should everyone send their child to?
Oh, without a doubt, the University of Florida.
Go
Go
Gators.
Gators.
All right, Brett. Take care, buddy.
See ya.